Hey, what's up? Welcome back to Chalk Talks with Coach B. Here's the hook today. Selling calls for income normally means owning 100 shares on a $100 stock. That's $10,000 tied up before you collect a single dollar. I'm going to show you how to run almost that same play for around $22.50. That's the poor man's covered call, the next chapter in the income playbook. This builds on the covered call and on spreads. So watch those first if you haven't. I'll link them up top. Drop questions in the comments or on the stream. All right, let's get into it. One sentence. Instead of buying 100 shares to sell calls against, you buy one deep in the money, long dated call, a LEAPS, to stand in for the shares, then sell a shorter dated out of the money call against it for income. Technically, it's a diagonal debit spread, but poor man's covered call tells you what it's doing. A covered call on a budget. You swap 100 real shares for one deep LEAPS that moves close to dollar for dollar with the stock at a fraction of the cost. Same engine, way less capital. Why deep in the money and why long dated? Deep in the money means high delta, around 80 to 90. So the call moves almost dollar for dollar with the stock and acts like shares. It's also mostly intrinsic value with very little extrinsic, that time premium that decays away. And going a year or more out keeps decay slow. Don't use a cheap out of the money call here. That's almost all extrinsic and it'll bleed out on you. Deep, long dated, high delta, that's the stock substitute. Let's build one. Our stock's at $100. Step one, buy the long call. I go down to the 80 strike, deep in the money, about a year out, and it costs $24, $2,400 for one contract. Of that price, $20 is intrinsic, real, and locked in, and only $4 is extrinsic, the time premium. That's exactly what we want. Step two, sell the short call against it. I go up to the 110 strike, out of the money, about 45 days out. That's typically where I like to be for selling premium. I collect $1.50, $150 in my account right now. So my net cost is $2,400 minus the $150 I collected and $2,250. Compare that to $10,000 for 100 shares. That's the capital story, and it's the whole reason this strategy exists. Here's how it makes money. That short 110 call is decaying every day. Time decay, theta, and as long as the stock stays below 110, it withers to zero, and you keep the full 150. Then, just like the wheel, you do it again, sell another call against the same LEAPS, collect another premium. The LEAPS is the asset you keep. The short calls are the rent checks. A few cycles, and you've stacked real income against a position that cost a quarter of the shares. Let's walk the scenarios at the short call's expiration. 1, the stock drifts up to 105, still below your 110 strike, so the call expires worthless and you keep the full 150, and your LEAPS gained value too. Income plus appreciation, not bad at all. 2, the stock rips to 120 past your 110 strike. Same trade-off as a real covered call. Your short call is now in the money. You owe the move above 110, but your LEAPS gained value as the stock climbed, and that gain offsets what you owe. Your upside is capped past your short strike. You keep the 150. You just don't catch the runaway move. You either close for a profit or roll up and out. 3, the downside. And I always want you sizing this up first. The stock falls to 80. Your LEAPS worth 24 is now around $4, down roughly 2,000. But 100 real shares would have dropped from 10,000 to 8,000, also down about 2,000. You didn't lose more than the shareholder in dollar terms. You just lost a bigger percentage of a smaller stake, and you kept that 150 as a cushion. The LEAPS lets you control the position for less, but it doesn't protect you from a falling stock. Now, the real risks, because this isn't free money. First, never sell your short call below what your LEAPS breaks even at. Your LEAPS cost 24 on the 80 strike, so it breaks even around 104. Sell below that, and if the stock blows through it, you could be forced to close the whole diagonal for a loss even though the stock went up. Always keep the short strike above your long calls break even, so a called away outcome is still a winner. Second, the LEAP still has that little bit of extrinsic value, the $4 in our example, and it slowly decays. It's small and slow because we went deep and long dated, but it's real. A lot of traders roll the LEAPS out before its final months, where decay picks up speed. Third, early assignment. If your short call goes deep in the money, especially right before an ex-dividend date, it can get assigned early. You don't own actual shares, just the LEAPS, so you'd exercise the long call or close to settle. Know your dates and don't let a short call sit deep in the money through a dividend. So that's the poor man's covered call. You swap $10,000 of stock for one deep, long dated call around 2,400 and sell calls against it for income every cycle. The trade off is capped upside and full downside exposure. But for a smaller account chasing income, it's one of the most capital efficient ways to do it. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research, know your risk tolerance, and talk to a financial advisor if you need to. That's it for today. If this helped, hit that like button, subscribe if you're new to the Income Playbook, and leave me a comment. What strategy do you want me to cover next? Good luck in the markets, no matter what stock you're into.